following is a paid advertisement program provided by Premier Investments and Wealth Management. An airing of the program is not to be considered an endorsement or recommendation. The opinions expressed are those of the hosts, guests, and callers, and not necessarily of this station or iHeartMedia. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. The information in the following program should not be construed as an offer to sell and is not intended to replace the advice of a qualified tax advisor or legal counsel.
Hello there, and welcome back to another edition of the Premier Investments and Wealth Management Financial Program. My name's Doug Wagner, your host. I'm going to introduce you to the man who is the president and wealth advisor at Premier Investments and Wealth Management with over 21 years of experience in the financial services industry. He's an accredited investment fiduciary, and also he is known as the Big Kahuna, Roger Abel.
Well, thanks, Doug. I feel like you practiced that while you were down in Mexico.
Yeah.
I haven't seen you for a while. You know, we pre-record a few of these shows. It seems like it's been forever, but how you doing?
It does. You look fabulous.
So do you.
Tan, rested, ready.
I wish I was tanner, but I don't tan.
Yeah.
I am getting ready for the holidays. You know, ironically, Christmas is almost here.
Right. Yeah, I know. It's just one of those things where the time just marches on. And so before our listeners go any further, I want you to hold back a little bit. Maybe you're listening to us on your phone through the app. Maybe you're doing this on a tablet. Maybe you're at a laptop or even your desktop. However you're doing this, I want you to open your favorite browser, point the URL at premieriwm.com. Click Get Started, and from there what you can do is you can fill out the answers to the questions and get yourself your Premier Vision document. Very simple document that has a lot of really good information in it. There's complex information on the inside of it when you want to know it, because they'll schedule an appointment with you, sit down with you, and you can take the document home as well. It gives you an idea. Am I ready for retirement? Am I ready for whatever the next step in my investment life has for me? It's important you find that out sooner rather than later. Again, premieriwm.com, click Get Started. Or you can also call if you're interested to make an appointment with Roger or one of the other associates here. What's the phone number?
800-383-6590.
I love these, Roger, because we get the opportunity to do listener questions very often. And let's answer this one from Steve, who says, my wife and I have a small balance left on a refinanced mortgage at 3%. Would it make more sense to pay off the remaining balance using a portion of her 401k or with my IRA? I'm 70 years old and on Social Security. My wife is still working until she turns 70 next year and qualifies for her maximum Social Security benefits. So, Roger, what are the first things that you identify in this question as the things that you need to know in order to answer this question properly?
That's actually the best question you could ask is, what do we need to know? And we don't have all the information here.
Right.
But I think when someone's thinking about paying a mortgage off from a 401k or IRA, the question to ask yourself is, why are you in a rush to pay it off?
Okay.
Because there should be a reason why you want to pay it off quickly, especially at a 3% rate. That said, I understand the emotional part of being debt-free once you're done working. And, you know, because being debt-free really starts to eliminate risk. But the first question is, why do I want to pay it off? Is it a cash flow issue? If it's a cash flow issue, then maybe we look at doing that. But if it's just because you're trying to follow some blanket advice, we really need to analyze, if I take a withdrawal from this 401k, one, how big is it?
Right.
What's it going to do from a tax standpoint? Is it going to make my Social Security taxable? Is it going to bump me to another tax bracket? Could it potentially make all my capital gains taxable? Like, there's so many moving parts that could happen here. I just caution people to take a big lump sum out of an IRA to pay off a mortgage. And we don't know how much it actually is.
Small balance, but who's small balance to them might be a big balance to somebody else.
If it's $5,000, probably doesn't make a difference. But a small balance to somebody could be $150,000.
Right.
And when you start to think about a lump sum distribution from an IRA or a 401k for $150,000, well, I know all that money's taxed at 22%, right? It could potentially, if you go over 200 and I think it's 6,000 household income,
Right.
it can increase your cost to your Medicare. And that's with you for 2 years.
Yeah.
So there's a lot of different moving parts. And one of the things we really like to do with people when we get this question, especially if they're over 65,
Okay.
because there's ramifications from Medicare and different costs that are out there. And we do this with Roth conversions too. But right in this spot, we want to model this not only in your financial plan, but two, we should be modeling it in some type of tax software to see how it's going to affect everything else in your life.
Okay.
It's kind of like a puzzle. When you move one piece, all the other pieces move too. Like changing one thing changes everything.
Yeah.
So instead of just jumping to action because somebody said you have to have a paid off mortgage, well, maybe you're going to. Maybe it's a 3-year plan to get it done. Maybe it's 2 years. Maybe it's 4 years. And you do this in concert with your values and paying the least amount of tax possible versus the most.
Right.
Because an IRA or 401k that's not Roth, it's going to be all taxable. So we want to make sure it's not negatively impacting our future outlook for retirement or, increasing our Medicare premiums that a lot of people don't even know that exists. They get the nasty surprise 2 years later. Oh, wait, your Medicare is going to go up and it's going to stay with you for a while.
So there you go. The big kahuna, Steve, says ultimately it depends. You need to sit down with your wealth advisor to find out so that they can do some financial modeling and tax modeling for you looking into the future. Great answer to that question. That's a really deep one.
Well,
Another listener question for you here in the Premier Investments and Wealth Management Financial Program. Barb asks, I'm recently divorced. My ex-spouse handled all of the money and investing while we were married. It's been about 2 years since everything was separated. I really haven't done anything since we separated the assets into our own names. Are there things I should be doing every year with my investments? Again, a very, very good question. And this is not an uncommon happenstance, Rogers, that you have one spouse that handles the investments. In fact, in some families, you have one spouse that handles all the bills and the current stuff like that, and somebody else that handles all that investment opportunity. And it really can hurt you if that's the case and you walk into a divorce situation.
I think this is a very, very common scenario that unfortunately half of the people in America face. And what's the divorce rate? About 50%?
Right.
Very rarely do I have a household that I work with where both individuals are dialed into not only the bills, but the investing too.
Right.
So if you look at your financial life, like from a medical standpoint, let's say, just treat it like a physical. Every year you should do an annual physical, and it's just the checkup. Tries to find all the hidden problems.
Okay.
They will inspire you to lose a few LBs because you don't want to get on the medicine, whatever it could be. Just make sure you're on track and check up on your financial well-being. And what I've done is I've come up with a list of items that I believe everybody should do, whether you're divorced or not. If you're the driver in the house, if you're the financial driver, which most common is one person, typically there's one person uninterested. The other person does everything. Now, the uninterested person gets interested occasionally. And by doing this little checkup, you can fill them in on what's going on. Like in our house, occasionally, my wife gets interested. And that lasts about 20 minutes, and then we're good.
And that's right. This is a really good idea because you have this information. You can just put it together. Let's go through the checklist one by one to make sure that people have it sort of what it is and why it's important to be on the checklist.
So one, evaluate your emergency fund. You should have a well-funded emergency fund, about 6 months of expenses, especially if you're a single individual. So when you were married, and assuming you shared money with your spouse, typically would share if something bad happened to you, I would hope. But when you're an individual, if you lose your job, you have no way to pay the bills.
Right.
So you definitely need to have an emergency fund of at least 6 months. Okay. That's step one. 2, check your beneficiaries. Because when you get divorced, you might want to change your beneficiaries. I have seen instances, and it's very common to get a divorce and not think about changing the beneficiary on the 401k or the life insurance or whatever is out there. And if you have a named beneficiary product, so 401k, life insurance, IRA, whatever it is, that named beneficiary will supersede a will.
I need to take a step back to the evaluate your emergency fund because you said 6 months of expenses. Now, if you've spent 2 years since your divorce and you're still not really checked in with your finances, you may have to I'm going to put everything into a piece of software or an app and do this. And make
Quicken,
sure
everydollar.com. There's a lot of great free places that you can at least get a handle on this. And it's a good point. I probably skipped ahead.
No, that's fine. I just wanted to make sure because that was something that's really important because it's not the percentage of your income. It's the 6 months of your expenses so you can simulate that.
Yeah, that's a great point. And I'm taking it for granted that an individual went out and did a quasi budget. Mm-hmm. If you haven't done that, that's probably step one.
Right.
Get a handle on your budget.
Mm-hmm.
Feel like your financial goals are just out of reach? It's time to take control of your future with Premier Investments and Wealth Management, your partner in financial independence. Imagine a financial plan that's as individual as you are. At Premier Investments and Wealth Management, our team of experienced advisors will work closely with you to create a roadmap tailored to your dreams, whether it's buying a home, retiring comfortably, or starting a business. We believe in transparency and education. We'll help simplify complex financial concepts, provide clear guidance, and empower you to make informed decisions. Financial wellness is within your grasp. Visit www.premieriwm.com to schedule a meeting with an experienced advisor today.
Then, 6 months of your living expenses in the emergency fund. Review your beneficiaries. Then ultimately, we start to talk about longer-term financial goals. If you think about your annual planning, it's just like building a house, build a really good foundation. And as you go up, get to the world of complexity at the top. Mm-hmm. So next, what are your financial goals? Have they changed? Financial goals actually change more often than you think.
Yeah.
I can think of so many circumstances where the goal was this, and 2 or 3 years later, so many things has changed that the goal is no longer the lake house. Now the goal is, hey, we want a bigger house here. Whatever it could be, like things change in life, experiences change. So
after my second divorce, my goals changed considerably because I went from having all that, all of a sudden, I wanted season tickets to the Pittsburgh Pirates, Pittsburgh Steelers, and Pittsburgh Penguins, and just to be a janitor in Pittsburgh.
Did you feel like you just got out of jail?
I just was like, you know what, I'm going down to the minimal. But then, I met somebody, and now here I am in the maximalist life again. But especially after the divorce, you're going to have significant different financial goals
100%.
than when you're paired with somebody.
Well, and a lot of times your financial goals may have aligned with theirs.
Yeah.
So now it's like, okay, if it was a single individual, what's the outlook? And fortunately I haven't been through that. You have. My guess is that in the short and this is 2 years after she's been divorced though.
Right.
You probably have an idea of what you want things to look like in the future. It's not like this was 6 months ago. This is 2 years. Things are settling in. Some people say, hey, I'm never getting married again. Mm-hmm. Some people are looking for somebody. I think things get more clear after you remove yourself from that a little bit. And then ultimately, once we start to do the goal, do you have something to say?
Yeah, I know. I just want to remind people that they are watching and listening to the Premier Investments and Wealth Management Financial Program right here on iHeartRadio. Also, you're checking it out on YouTube, too, as well, which is really kind of cool. Roger Abel is with me, and you can get in touch with him at premieriwm.com, or you can call for an appointment today. They'll make an appointment with you anytime you want. 800-383-6590. We're in the middle of answering Barb's question, what do I need to be doing every year with my investments? It's much more complicated than that, but I wanted to remind people of what we were doing at this point and who you are, why we're here. You talk about getting another step out there is updating your financial goals. And then the next thing you have here is reviewing your asset allocation.
Where we're going with everything on this list is teeing you up to make sure your financial plan is updated.
Yeah.
And why, and if you haven't created a financial plan, you should do one. But why it's important to update your asset allocation. If your goals have changed, we assign goals some monetary value typically. Mm-hmm. You may need to become more aggressive with your investments. You may need to become less aggressive to put yourself in what we call the highest probability of success,
right,
or the optimal outcome. Mm-hmm. And the results of your financial plan should really drive your asset allocation. This shouldn't be shooting by the hip.
Yeah.
Now, if you're 40 years old, your asset allocation is likely all stock, right? So I'm probably skewing here towards people that are 50, 55 and older within 10 years of retirement,
Right.
saying, hey, we need to make sure the asset allocation is reviewed. If you're 25 years old, you're likely you should have a 100% stock portfolio. We need to not worry about our asset allocation. If you're 25, we're only worried about, how much we're saving. So I definitely want to, make sure I put that out there. But if you're approaching retirement, you're within 10 years of retirement, you want to make sure you have the asset allocation right. Because that's going to get you to where you want to go long-term.
Yeah.
Okay?
Makes sense.
And then ultimately I mentioned, what's your savings rate? If you're 35, your only focus should be your savings rate right now. Is my savings rate on target to accomplish all of the financial goals that I had? So let's step back to financial goals. You're now divorced and you want season tickets to the Pirates, the Steelers, and your income's getting cut in half. Boy, we probably should figure out if our savings rate's still going to be enough to retire.
Yeah.
If we're going to spend, cause I don't know what they are, but I'm guessing.
Well, it's the Pirates. They're horrible, so it's probably not that much. But the Steelers,
it's probably
I'm
several
kidding.
$1,000s
Yeah,
still.
exactly.
And the Steelers are lots of thousands of dollars. So you can model all that in the financial plan. And then ultimately, okay, can I afford to do this? Too many people just go do it. And then, doesn't work. I was actually, do you know what the financial audit is? Have you ever watched the financial audit?
No, what is that?
It's a guy on YouTube.
Okay.
And he brings people in and goes through their finances with them and kind of tells them all the silly stuff they're doing.
Yeah.
And
it's like bar rescue for people's individual finances.
Okay. Has a guy on there. This kid's like 23. He has season tickets to the Timberwolves. He makes like $46,000 a year.
Yeah.
Guess how much his season tickets are?
$10,000.
$1,250 a month, roughly. He goes, where are these? He's like, well, they're in the club level. Yeah, that was his response exactly.
What?
Was like, why do you have club level tickets? You don't make any money.
Exactly.
But it just goes to show he didn't take a look at the savings rate, so he clearly wasn't saving enough to get to retirement. He's spending all his money on those club level tickets.
Yeah. It's interesting because you mentioned the savings rate, and then I'm looking at the next thing is something that I've gone through, and I've actually done a lot more. I've done some refinancing. I've improved my credit score significantly here over the last 2 years. Been really working at it, doing things and taking actions in order to do so. That really can do a lot, especially if you are divorced. It's important for you to check your credit score because that whole situation can really leave a negative imprint on your credit score.
Yeah, that's one half of it. What happened in the past? The second half of why to check your credit score, in my opinion, assuming you're responsible, you don't have any credit issues, there's another reason out there. Make sure someone hasn't stolen your identity. Make sure there's an account not open that you didn't open. Fortunately, I get monthly alerts from credit card providers and all my stuff. And I watch it pretty closely just because it's more of a pride and a game thing.
Yeah.
It's kind of fun. Well, I guess, I don't know if it's fun, but it's fun for me.
Yeah.
But it's important because your credit, if you're still in the world of borrowing money, which most of America is still borrowing money either for a mortgage or whatever they need, that credit score drives your interest rate in most cases. Now, obviously, in today's environment, nobody's getting a 3% mortgage.
Right.
But a good credit score could be the difference between 6.5 and 7.5. Or you really see for people who are borrowing for vehicles, you have bad credit, you can pay a lot on an auto loan.
Oh, yeah.
There's a lot of places that arguably are predatory lending, right? 15, 18% interest because your credit stinks. But that's why it's important to check your credit score every single year.
Yeah, and that makes sense, especially with the divorce, because you're going through a lot, and you want to make sure that you're financially disentangled with whomever you had been tangled up with in the first place.
Well, and think about it, like your credit line changed. So, if you think about the factors that go into a credit score, it's amount of open credit.
Yeah.
Like what's available.
Joint cards, yeah.
Yeah, so what's available? Well, if you used to have $70,000 available, now it's $35,000. And you have a $10,000 balance, you're using 30% of your credit. That's negative. They want you to be using less than 10%.
Yeah.
So your credit score could have inadvertently changed because of your situation that you're with your spouse. And the other thing is, if you have credit limits that are high and your income just got cut in half, they're likely going to look to cut your credit limit.
Yeah.
So it's just something to really stay dialed into. Make sure you know what your credit score is. Make sure you know what your open credit is. Make sure you know what's used. And like I said, there's a lot of the companies now are sending information to you. Hey, there's no alerts, or you're used 5% more of your credit, or your balances went down 5%. They'll alert you to all of these different things that are happening.
And the good stuff too. It's like, hey, you've got, X number of non-late payments in a row. I mean, which is really...
You know how many years it takes to get like a positive, an excellent score on-time payments? Or is it to get an excellent score on open credit? It's like over 20 years.
Yeah.
Because I just had my first open, like, go over. I'm like, well, how can I not have excellent?
Yeah.
Let's see. You've only had 19 years. I finally have some debt. I have a open piece of credit for over 20 years now. Because that's one of the factors. Like, how long have you had credit? How many on-time payments? All those different things.
That makes sense.
So on-time payments, though, that's a big one. You know, missed on-time, like not a 30-day late payment.
Right.
Dings your credit like 60 points.
I know.
60.
That hurts.
It's not if you missed it by a day.
Right.
It's typically 30 days late.
Yeah, because that's when they do the report to the credit bureau. So
it was due September 1st. You didn't pay.
Till mid-October.
If you don't pay till mid-October, you're going to have a problem. It's 60 points, and it takes probably 5 or 6 years to get that off.
And absorb that. Another thing you need to do if you have just gotten a divorce and you're looking to do your financial checklist on this is assess your insurance coverage. This really makes sense for a number of reasons. All your insurance coverages too, not just life insurance, but your casualty and property insurance too.
Yeah, I mean, if you think about insurance, here's what it encompasses: auto, home, life, health, disability, potentially long-term care, and then one lots of people forget about, and that's your liability coverage.
Yes.
It's one of the most overlooked items of insurance out there. Think of liability coverage as the oh crap blanket that goes over everything. If you've got an auto coverage and you see those numbers on your auto cards that say I have 200,000, 500,000, 200,000, whatever the numbers are.
Right.
Those are your liability coverages. If you go buy a $2 or $3 or $5 million liability umbrella, it adds coverage above you and protects for the really bad things. And arguably, it's one of the least expensive insurances you can actually buy.
And the whole point of insurance, too, is to make sure that you have the protection you need. You're paying for it, hoping you never have to use it. So that's a huge thing. A lot of people complain about it. So, why should I pay for that if I'm never going to use it? That's the whole point.
I hope I never use my insurance.
Yeah.
That's the idea. But if people shifted the thought, insurance for the things, you're buying insurance for things that you can't afford to fix or replace.
Right.
Right? I mean, if you've got $1 million of cash in the bank, you have $5 million in an IRA.
Right.
And you buy a $100,000 car, you could have liability only insurance if you paid cash. You don't have to have full coverage because you can afford to go replace the car.
Yeah.
So instead of paying, $3,000 your insurance, maybe you're paying $600, but you're taking the risk.
The risk. You're self-insuring.
Yeah. Everybody wants to get to the point where they can self-insure, right?
Yeah.
I mean, ideally.
Oh, yeah.
I mean, yeah.
Can afford all of it.
If I could self-insure, I would. But we pay for insurance for the things in life that we can't afford if something bad happens.
Check that right there. That's Roger Abel, Premier Investments and Wealth Management. We're talking about his checklist that you need to. It's a yearly financial checkup you can give yourself, ideas to uncover hidden problems and inspire you to set some new goals. The insurance coverage thing also reminded me as well that it's important to make sure that you do check in with your human resources department. If you are still working, check in with the human resources department. Make sure that things are where they need to be as well. I mean, you would be surprised the number of stories that I've heard of people who, because of there's again that financial entanglements that go back with your spouse for so many years, the disentangling of them sometimes kind of falls apart. So make sure that you're completing that. Now, the final thing is to meet with your financial advisor. But here's the important thing. If you don't have one, you really need to get one. And this is one of the reasons why. If you're sick, you go to a doctor. If you have legal issues, you go to a lawyer. If you got soul issues, you see your priest, rabbi, your imam, or your pastor. If you got financial issues, and everybody does, you need to have a wealth advisor. Get in touch with my friends at Premier Investments and Wealth Management. Talk to me about the importance of having these regular meetings with your financial advisor, Roger.
If you start to think about your financial life like your car or your health, you go to the dentist twice a year to get a cleaning.
Mm-hmm.
Why do we do that? To avoid the root canal.
Yeah.
Right? I mean, that's why.
Oh, yeah.
If cleaning didn't prevent the root canal, well, you would never get your teeth cleaned.
Mm-hmm.
That's why you go there to do preventative maintenance.
Yeah.
Why do you get the oil changed in your car? Preventative maintenance.
Yeah.
I mean, it'd be great if we never had to change oil. Maybe, do you have to change oil in electric cars?
You know what? I don't think so because it's an electric motor. I think that there's it's a closed loop system. I don't think it goes anywhere.
But either way, you're doing maintenance.
Mm-hmm.
That's the same thing in your financial life. If you don't have a plan, go get one created and then do the maintenance. Maybe it's just once a year. You're meeting with your advisor saying, okay, here's my new goals. This is how life's changed. You know, I got a raise. What should we do? And you just start to strategize and put some meaning behind what you're doing. If you're just going to your advisor to find out how you did, okay. Like you probably already know.
Yeah.
You're checking online every day. 27% of our clients check every day. We know because we get a little alert.
Yeah.
Tells us client engagement online.
Right.
Like who checks their account balances. Doesn't tell us who, but it shows us the engagement.
Right.
But at the end of the day, why wouldn't you do maintenance on your financial life? Realistically, it's going to take an hour or two a year.
Yeah.
And delegate it to someone else.
Mm-hmm.
And you're just striving to get a much better outcome long term.
Exactly. And this is one of the neat things, too. I'm going to remind you that we're talking about somebody who's been divorced for 2 years. And if you had a financial advisor when you were married and you're like, you know what, maybe I'm not going to use that financial advisor, it's fine. You need to do a series of interviews. I mean, the whole point of it is that you're going to be interviewing a new financial advisor potentially. And even if you have one, it's never a bad thing to get kick the tires sort of thing. Do a second opinion on all these things.
Go talk to 3 people.
Mm-hmm.
Figure out who you like best.
Yeah.
The fees are all probably about the same.
Right.
I mean, I truly believe that. Find someone you like or you connect with. You have a common interest, someone that you can trust. If going to your advisor is like pulling teeth and you just can't stand to go, then you have the wrong advisor. And if you don't like going to the advisor probably doesn't really like when you come either. We've had those situations before.
Yeah.
You know, that's okay.
Where you just tolerate one another. But you'd rather have somebody you can work with.
My best clients, you have a good time.
I always enjoy going with you to the Premier Investments and Wealth Management outward-facing Christmas party. I love the inward-facing, but the outward Christmas party.
Did you get invited to the company party this year?
Yeah.
Okay, I'm just making sure.
Both. So the reason I like the outward-facing one where all the customers are there because I love seeing the relationships that have been built over the years because I've been working with you for, 10, 15 years now, somewhere around there.
Yes.
And seeing the relationships that you all have built and the meaningful ways that you helped to change so many lives as they've gone through situations from, maybe they were getting ready to be empty nesters to now they've got grandkids and they're planning for their legacy. This is the reason why you do a yearly financial checkup is because in case an oops happens, you can take care of the oops, and my friends at Premier Investments and Wealth Management will help you. Roger, what's the phone number in case people are so motivated right now they just want to pick up the phone call?
800-383-6590.
You can also make an appointment at premieriwm.com. That's premieriwm.com. There we go. Got another one of the books. For Roger Abel, I'm Doug Wagner. Thank you for attending the Premier Investments and Wealth Management Financial Program. We'll talk to you again next week.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.